Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look ahead to the upcoming US CPI release coming out on the 10th of April. This is going to be the big ticket item for the week, and it comes in a week that also sees central bank decisions from the ECB, the Bank of Canada, and the RBNZ. But ultimately, I think this inflation report is going to be the one that really does hammer home the possibility that we don't see US inflation return to target anytime soon. And certainly that could be a shock to markets. So let's just dig into it and see exactly what markets are looking out for and the potential implications going forward. In terms of market expectations, the core reading is expected to drop on a monthly basis down to 0.3%. That helps the core inflation rate drop down to 3.7%, still a way away from target. But the headline number is where it's at. You can see here the expectation is that we once again see a tick lower in terms of that monthly reading down to 0.3, which would be welcome. Nonetheless, that drives up the year-on-year figure. And really this alludes to the base effects that we can get into right now with the usual chart that I provide you guys. It essentially highlights exactly where we are at the moment, how things have been broken down on a month-on-month basis, and an annualized reading to tell us where we could be going. So first and foremost, we're around 3.2% on that year-on-year figure. But as we saw previously, markets expecting it to rise this time around. And why is that going to happen? Well, we can see that this month around, we're going to see March dropping out from the 2023 metric and in on this side in 2024. So what are we having to replace? Well, 0.078 is what is being replaced. And if you look at the reading either side of it, say February and April, both of them significantly higher, both of them pretty healthy readings. So when it comes in a month where the figure that's dropping out was a particularly high number, then it's easier to drive down the year-on-year metric. But when you're replacing a very low number, as we're seeing this time around, then you're likely to see the year-on-year metric rise, which is exactly what markets are expecting. Now, bear in mind that that expectation of 0.3% on a monthly basis would fly in the face of what we've been seeing in terms of the trend, because as you see in the middle of this chart, you can see on the monthly figures, we've now seen 1, 2, 3, 4 consecutive gains in terms of the month-on-month readings. The last time around was 0.442. And we can get into a little bit later about the impact of energy, but there's a good chance that we don't necessarily see that 0.3 figure, and we instead continue to climb or see another strong reading, which could see a greater than expected rise in terms of that annualized, in terms of that year-on-year figure. The annualized number that we can see at the moment, well, it's 11 months, which essentially means that if the new number comes in line with the average of what we've seen over the last 11 months, what would it look like? Well, it would come up at 3.4%, which is what markets are expecting anyway, which essentially points to the notion that 0.3 is roughly the average of the last 11 months, which you can kind of eyeball that within this chart anyway. But all in all, you're talking about an increase to inflation with markets expecting to see a rate cut in June. Well, where's the justification for that? We've just come off the back of a strong jobs report once again. And some of the comments from Fed members really do allude to the idea that we may not necessarily see it immediately. This is a monthly comparison for inflation across a number of different regions. You can look at this in your spare time and maybe pause it so you can actually take it all in. I would say that if you're looking out for what's sort of notable on this time around, what you would like to see is small numbers on the right. So the recent trend is for disinflation or lower levels of inflation, but chunky prints on the left, which means that you're going to see big numbers dropping out, and that has a significant disinflation impact. Well, where do we see that? Certainly, I would say the one that stands out is the United Kingdom. If you look at the figure that's about to drop out, it's pretty chunky, to say the least. That's the April figure, sorry, and then also May, another strong figure. In terms of the US, well, you know, I would say the April number is a decent size. So once this month's over with, but then beyond that, a number of small ones. So it essentially points to the idea that, you know, maybe we see a bit of disinflation in April, likely to rise this time around, maybe drop back a little bit in April. But from there on in the next 3 months, there's a good chance that we don't necessarily manage to go anywhere in terms of driving down inflation. So again, there's significant concerns around the idea that we're going to see the Federal Reserve cut rates anytime soon. And this really highlights that, and also highlights the fact that the UK is in a relatively decent position to drive down inflation pretty heavily over the coming months. Then we'll look at what's happening in terms of core. Now, core we can see on the CPI front, 3.8%. So elevated compared to the core PCE number, which is at 2.8%. So PCE, as I've mentioned for a number of months now, is the metric that is most likely to get back down to target. Core CPI, headline CPI, they don't look like they're going to do it anytime soon. 3.8% this time around. Like I said, the expectation is that we are going to see some disinflation coming into play this time around. Let's look at the monthly breakdown to see exactly where this disinflation is likely to take shape and where we could see lulls in that disinflation. As you can see here, the blue columns are for the core CPI. So the past couple of readings have been pretty strong. 0.358 was the last one for February. If we're looking at sort of last March, well, 0.325. So you could see a bit of disinflation this time around. Next month is a pretty chunky print for April. So the next 2 months, we could see that disinflation continue. And then June, July, August, probably not. So if we're at 3.8 at the moment, market's expecting 3.6, then, maybe we can start drifting down closer to 3% in a few months' time. But we're not necessarily going to get back down to target anytime soon on this metric either. Like I said, core PCE probably best equipped to do so. But if you look at the last 2 orange sort of candles or bars, both of them have been pretty strong for the core PCE, and that sort of pushes back and raises up the annualized figures that, as you can see at the moment, the 8-month annualized. So essentially, where are we going to be in 4 months? That has ticked higher over recent months, now up in the sort of mid 2% range, whereas previously it looked like we were going to get back down to target for the US. A few different charts to look at. This is the US M2 money supply versus inflation. So essentially, generally you have a relationship between money supply and the actions at central banks, and that relationship with a significant lag. As you see on this chart, we've got a 16-month lag attached to this, should point towards how the growth or the shrinking of money supply within the US economy impacts prices. And by and large, we have seen that in the past, and it appears to be treading on that trajectory. That points towards downside for inflation. But the caveat is that we're starting to see some upside in that money supply change. You can see it still is in negative territory. So certainly a move back above that 0 mark might be a little bit of a warning sign, but that still does point towards some disinflation to come. This is something that's come out over the course of the past week, where we saw the ISM services PMI come out, and we saw some encouragement from the fact that we saw a sharp decline in the prices paid metric of that release. And again, I thought I would chart the two just to say, look, these are the stories that you're seeing. These are the headlines, but how does that play out? And by and large, we can see that generally that prices paid metric will roll over or rally ahead of inflation itself. So this is a good metric that can front run moves. And with the decline that we have seen this time around, that gives us a bit more confidence that we could see some disinflation in the coming months. In terms of US CPI versus PPI, which essentially is input prices, factory prices, and alike, we can see that by and large, both appear to be near enough flatlining now. They've had this downward trajectory in sort of 2022, 2023, and now we've just kind of moved into this, it's mainly 2022, 2023, largely dominated by consolidation. And so we can see a similar kind of trend between the two. It doesn't necessarily point towards sort of input prices signaling downside for consumer prices. So that's worth noting. And another key thing that's obviously really hit the headlines over the past week, where the raised concerns around a potential conflict between Iran and Israel saw a spike in terms of energy prices. We've seen Brent crude above $90 a barrel for the first time in over 5 months. And by and large, we have seen crude oil gaining over 20% over the first 3 months, just over 3 months of the year. And of course, inflation is driven by a number of factors, but energy is the most volatile factor within that. So if we saw a surge in terms of energy prices, as we have been seeing, that's going to have a knock-on impact in terms of inflation. And certainly it's worth bearing in mind. I mean, if we looked back at that first chart that we looked at in terms of month-to-month inflation, like I said, 4 consecutive gains in terms of the pace of inflation, right? Most recently, 0.4 gain on the month, 0.44, and markets are expecting 0.3. But bear in mind the upward trajectory in terms of crude oil and gasoline does point towards the possibility of further upside in terms of CPI, headline CPI in itself. So there is a correlation between the two. The upside move in terms of crude oil and therefore the price that will be paid at the pump should put upward pressure on inflation. And if we saw that inflation figure on a month-to-month basis coming in above 0.3, say at 0.4, then the warning sign that is likely to come, even if we do see it come in line with expectation, is going to be felt even more keenly, I would argue. In terms of market expectations for the next Fed meeting, 93% expectation that they will hold rates, 40% expectation that we see them hold rates in June, and therefore essentially 60% chance of a rate cut in June. I'm just going to very quickly check to see if that's absolutely accurate, because I just want to make sure that it's the most up-to-date number. So 94%, we've now shifted to a 45% chance of a rate pause at that meeting. So it has increased 5%. Because I took this screenshot on Thursday and it's now Friday, and we have seen a fair amount change in terms of that time because of what's happened in terms of the energy markets and some of the comments coming from Fed speakers. So we're gradually seeing a repricing away from that rate cut in June. And I think there's a good chance that we don't see a rate cut in June. But I think that this inflation report is likely to hammer home the idea that June is likely to be off the cards. Because the increase in terms of energy prices that we've seen just really reiterates the point that inflation isn't at target. It's not necessarily heading in that direction at the moment. And so the idea that they can suddenly call it a victory and move on from it and start to cut interest rates seems somewhat foolish. Other central banks might be in that position. And I would argue that the likes of the Eurozone and the likes of the Bank of England seem much better equipped to cut interest rates in the near term compared to the Federal Reserve. Let's look at some charts. First and foremost, this is the S&P 500. Let's just get on the big screen. The pullback recently taking us down through trendline support, but into this 76.4 fib. We've tagged it on 2 days in a row and now moving towards the upside. The caveat here is that we are not out of the woods quite yet. And like I said, I think that this report is highly likely to really sort of hammer home the idea that we might not see a rate cut in June. Do markets care that much? Are they just constantly willing to think, okay, it's fine, you can keep pushing it back? Well, time will tell. But, that has been kind of the case so far. We've seen a massive repricing away from 7 rate cuts this year and into 3, and now, like I'm saying, I think there's a good chance we don't even see 3. But markets continue to see record highs irrespective of that. I'm just drawing the fib on the initial one. You can see that this initial pullback came into your 76.4 fib. Let's see exactly where this latest move has taken us into. So deep, it's taken us through to 61.8. But not necessarily 76.4 fib. I think there's a good chance that this rally that we're seeing at the close of the week is setting us up for another pullback. If we see a strong inflation number and we see, there's a number of Fed speakers appearing over the course of the week to come, I think that's a good chance of giving us a bit of a risk-off play. Doesn't necessarily mean that this trend is over, because by and large, this market has been very resilient, irrespective of what's happened in terms of interest rate expectations. And so if we saw a pullback, maybe that's an opportunity for the bulls to get in. But I do think there's a good chance of a short-term sort of jitters coming into play around this announcement. The dollar index again, look, we've seen markets fearful around energy prices that have been very strong and pushing up through $90 a barrel for Brent. We've, of course, seen the comments coming out from the Fed speakers that essentially point towards a willingness to be relatively cautious. We've seen the jobs report that's come out strong, and yet the gains for the US dollar have been relatively fleeting. This inflation report potentially has the opportunity to correct that, and we could see some strength coming back into play once again if we see the inflation report really sort of hammering home the idea that we're not necessarily going to see a rate cut in June. Remember, 45% chance at the moment. So markets are expecting a rate cut in June. I think it's more likely we don't than we do, quite frankly. And that realignment could provide some upside for the US dollar. And a chart to really look out for here is the US dollar against the Japanese yen. This weekly time frame highlights just how notable this level is here. It's 151.9, essentially 152. We hit it back in October 2022. We've hit it again on November 2023. And here we are once again knocking at that door. Are we going to finally see that breakout for the US dollar against the Japanese yen? Well, certainly it's one to look out for. At the moment, it's looking like we could fade once again. But if we see a strong inflation gauge coming out from the US, that could signal a prolonged period of tight monetary policy from the Federal Reserve, and that could provide that upside move. But keep an eye out for this one, because if we break that 152 mark, then it's going to be headlines really, because you got to look some way back for the last time that we saw that level broken. We're talking about 1990. So certainly this is going to be a really key market to look out for, whether we see it roll over or if we manage to see it finally break out towards the upside and up through 152. But ultimately, whether you're trading indices or gold or commodities as a whole or the US dollar, I think by and large, this is going to be a big ticket item, because clearly the way that markets are continuing to price June as that first rate cut, it seems like people are relatively complacent. And as I've warned for months, the US is not necessarily in a direction to be able to get back down to target. And so really it's going to come down to whether the Federal Reserve is willing to cut, irrespective of the fact that they have not done the job that they need to do, which is drive down inflation. And the economy, as we've seen with the jobs report, is in a strong position, which again doesn't necessarily mean that they have the justification to fly against their primary concern, which should be driving down inflation over the near term. So watch out for this one. Markets are expecting a move higher, which could be a shock in itself. But I think there's a good chance with what's happening in energy prices and the trajectory on the month-on-month readings that we've seen over the past 4 months. I think it's a good chance that we also see it come in higher than expected, which could provide even more of a short-term jolt to markets. The caveat is, do markets care? In the past, they haven't. But a lot of that realignment happened during earnings season. So we don't necessarily have that to take our mind off of the potential sort of rejigging in market expectations for Federal Reserve monetary policy going forward.